What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be taking a look at Brown and Brown stock, which is an insurance company with a market cap of about $29 billion. And as you can see, this has been a great performer in the last couple of years. It is up 158% in the last 5 years. And so immediately when I saw this company's numbers, right off the bat for revenue and net income, they are both very consistent, growing trends. As you can see here, they're averaging about 12% to 15% growth over the last 5 to 10 years. Last year they did, or 2 years ago now, $4.2 billion of revenue. And then for income, we're looking at 870 million. And if we go to the trailing 12 months here, we can see that it is still very strong and consistent as far as the trend goes. 4.6 billion of revenue and $1 billion of net income. Let's go back to annual here and come down. Free cash flow, EPS, all looking good. One of the only weaknesses I don't like here is the balance sheet. The cash to debt ratio is over $3 billion of debt and only 700 million in cash, but it is what it is. If we go down to shares outstanding here, we can see that the trend here is not great, but not bad. It's just average. The dividend trend is very strong. As you can see, they pretty much always are raising their dividend, which is nice. And then their return on capital and profit margin numbers are very strong. 10% return on capital, which is not anything crazy, but it's still, at least it's consistent, at least it's healthy. Profit margin of 20% is actually very good. That's a very good number. Then we're going to go over to the history of the PE ratio. So right now, again, we're looking at about 4 PE of 24 right now. And that's right in line with the average. This company normally trades around 26, 27 times earnings. So this isn't the best time to buy, I would say. But if you can buy it when it's, let's say, below 25 times, maybe you get it at about 20 to 24 times, then I think it's a fair time to be buying this stock. Analysts have been doing, so look at this EPS jump. A year ago, 2.8 up to 3.7, and then now 4.1. So the EPS growth is looking very strong. Revenue is expected to the revenue growth is expected to decline just a little from 11.5% down to 8%. But again, that's not the end of the world. This is still a company that is trading at a fair valuation, consistent and strong trends in pretty much all their numbers. Besides, again, the balance sheet, cash to debt ratio is only the only weakness here. But other than that, everything looks good. The dividend is very small, but at the same time, the payout ratio is very small, which is a very good and healthy sign. But other than that, I'd be interested in buying this. Again, if the valuation came down to, let's say, 23 times earnings, I'd be happy to buy. But I mean, I wouldn't be surprised if it could also just stick around this 25 to 27 times. And, who knows? It could be a while before we get a chance to buy it at a cheaper valuation. But if it were to come down to, let's say, 23, 24 times earnings, then I'd be happy to buy it. So let me know what you guys think down below, and I will see you in the next video.